All right, good afternoon, everyone. I know there's always a pause before we begin, but I wanted to welcome you to another event of the CFA Society of Detroit. We're pleased to have you with us today. This is getting close to the end of our event season, but we hope that you stay tuned because we'll be sharing with you, other great presenters from our other regional societies. So we hope to see you at some of those as well. We have a great speaker today, so I don't want to hold you up for too long, Grant Williams. But before we introduce him, I just have a few housekeeping items that I'd like to share with you. The first is members, please vote. There was a vote that was sent to your email box related to the officers and directors for the board for the coming year. Please take time. We do appreciate your input on that. So thank you in advance. And then second of all, I'd like to say, our annual meeting networking event, unfortunately, will not be able to take place in person. So that will be held virtually on June 17th at 2 p.m. Please register. We hope that you can join us for that event. You'll be able to meet the incoming president. And with that, Ashley DeSteiger will be introducing today's speaker. Thank you for joining us.
Thanks, Julie, and thanks to Grant for taking time out of his busy schedule to spend time with our society. I'm honored to introduce him today. He has over 30 years of experience in the finance industry. Over that period, he has held senior positions at a number of investment banks and brokers in locations across the globe. After the events of 2008, Grant felt a need to try and ensure the misunderstandings and lack of awareness about just how bad things were becoming in the lead up to the crisis didn't happen again. His aim was to try and help people understand that despite mainstream media coverage to the contrary, nothing had actually been fixed. The can had simply been kicked down the road. From his humble beginnings in 2009, Things That Make You Go Hmmm has grown to become one of the most popular and widely read financial publications in the world. He's also one of the founders of Real Vision Television, an online on-demand finance channel showcasing the brightest minds in finance. He is a regular speaker at investment conferences across the globe, and he blends history and humor with a keen financial insight to produce unique presentations which have been enthusiastically received by audiences everywhere. So with that, I will turn it over to Grant.
There we go, unmute. Thank you very much, Ashley. I appreciate that. We've got about 5 minutes left after that introduction. I need to get someone to chop that down for you. Sorry about that. Well, thanks for having me. It's a pleasure to be here. I think what we're going to do today, there's just so much going on in the world, and things are changing so rapidly, as I'm sure everybody watching this understands. So I thought I'd run through the year so far and some of the pieces that I've written and some of the things that I've been looking at. Because as I went back through them in putting this presentation together, it was really clear to me just how much things have changed. And also it's useful to go back and look at what I personally, for me anyway, was thinking at certain points of the year so far. And then I'm going to try and skip through that in half an hour to leave plenty of time for questions, because I think the one thing that we've all got right now is questions, including me. So I'll give you answers to any that I think I've got even a plausible answer to. And if I don't, I'll be happy to tell you that. So let's kick this off and jump into some of these slides. So the first piece I wrote at the beginning of the year was called The Year of Living Dangerously. And funnily enough, it was about protests. It was about rioting around the world. And I was looking at the disparity between what's become known and referred to commonly as the 1% and the 99%, this wealth divide. And I would argue that this can be placed directly at the feet of the Federal Reserve in terms of what happened, but the parallels to another time where so many similar things were happening were all too obvious. This is a chart that shows the top 0.1% and their income share in the United States. And you can see we're back at levels that we last saw at the end of the Roaring '20s. And of course, anyone that knows the history knows exactly what happened after the Roaring '20s, the blow-off top there. We entered the Great Depression. And the characteristics were the same. We had the robber baron era. We had a lot of very, very wealthy people, wealth shrinking to a much, much smaller share of the population, and roaring stock markets, glitz, glamour, gaudy consumerism. It was all right there. And if we look at the wealth share, again, it's less pronounced, but it's clear. The wealth was going to the already rich. And we've seen that with this latest run in asset prices over the last 10 years. It's been consistent. This only goes back to 2013, this data that I could find. So I guarantee you now that that chart is way in excess of where we saw at the end of the Roaring Twenties. That obviously translates into this chart, which is a chart that shows the ratio of wealth or paper wealth, supposed wealth, the value of assets to disposable income. And it's just increasing as it says there. Disposable income is failing to keep up with so-called wealth as the consumer is getting squeezed more and more across the board away from that top echelon of society. I started looking at this when I was getting into social unrest and riots, and the trigger for that for me had been the Gilets jaunes protests in France, which have been quietly going on for almost 2 years now. At the beginning, they were all over the front page of lots of Western media, and then they kind of got booted off the front page by all kinds of other stuff. And now you very rarely see anything about it, but these things are still going on every week in France, and they're significant protests. And they've morphed from a protest about gasoline subsidies and gasoline taxes to the pension crisis in France, to Emmanuel Macron's popularity. And so I took a look at this stuff all around the world. And you could see even in January that what we're seeing now in the US is merely a spreading of something that had already begun. This was Haiti, where we saw a huge swarm of protests starting that were kicked off by the removal of certain subsidies, and then just enveloped the country very, very quickly. We saw the same thing in Ecuador. You see here gasoline subsidies, and it's always the taking away of subsidies or the implementation of taxes that tend to cause these things. You can see there the massive difference in diesel and gasoline prices with and without subsidies, and that set Ecuador on fire for several months. I brought this chart in as I was looking at that. This is Latin American political stability, and as you can see here, the US at the time fell below the political stability rankings of both Uruguay and Chile. I dread to think where the US is now. Perhaps we'll come on to that a bit later on. But Chile was somewhere that has been a very, very stable country in South America. And it's been politically stable for a long, long time. There are an awful lot of Western assets there, particularly in the mining sector. And so to see this protest wave sweep across Chile took a lot of people by surprise. And as you can see here, the wage growth over inflation has been averaging 2.5% for 40 odd years, and now it's plunged to 1% in a very short space of time. And that buffer that countries like Chile have, even though they're politically very stable on the surface, can ignite very, very quickly when people who are poor feel like they're getting poorer. And when we looked at Chile, the whole protest was sparked by an increase of 4 cents on a rush hour weekday subway ticket. That's all it was, just 4 cents. And so the employment and labor secretary compounded matters when he came out and told the students who were protesting that they should try and get to their lectures early before the rush hour started. I'm not sure that was the smart thing to do, and it set the country alight. The second piece I wrote in late January was this one, A Whole New Ballgame. And really I was just talking about how the world had changed. And the metaphor I was using was Steph Curry in the NBA, and how his phenomenal three-point shooting had completely changed the map of where shots were taken in the NBA. And every now and again, you get someone or something that comes on that can completely change a game. And I started to look through a bunch of things going on in markets around the world. And it's clear that things were changing back in, even in early January. And, I've been looking for some kind of event like we saw in February and March for way too long, frankly. But I don't think the Wuhan virus, COVID-19, whatever you want to call it, was the problem. It was the trigger for a lot of problems that were in the system. And some of these charts kind of go through those. We see here leveraged loans and the ratios of upgrades to downgrades. Sorry, downgrades to upgrades. The title's wrong in the chart there. My apologies for that. But you can see how quickly that started to rise since 2015, and the change in trajectory there at the end of 2019, as the stress started to work its way through the system, was very, very clear. contrasting that, covenant light loans, which, as you can see from 2013 odd, they've risen from 20% of all issuance to just about 80%. And that's been fine, and it will remain fine until it isn't. And what we've seen in the last 8 weeks or so is the kind of trigger that is going to make things like this chart matter a great deal. This is something I think you need to watch us very, very closely in the coming months as these bond defaults and bankruptcies start to ripple through. And there's plenty I want to say about bankruptcies when we get to the Q&A part of the session. Debt ratings, you can see here, the triple B and below is broadening out significantly. This is exactly why the Fed jumped in immediately with their fallen angel backstop. I feel very certain that at some point they're going to have to find a way, if they can, to broaden that out so it's not just angels that fell after March 20th. Because if you look at the data, you can see that what they tell you is that's not going to do it. That will not really put a dent in the potential problem that the bond market is going to present to central banks around the world. Average triple B yields, you can see here on corporate, this is the US, the UK and the EU combined. And you can see here what those have done going all the way back to 2007 since the crisis. And you can see the spike we had there going into 2008 from where they essentially doubled. This chart doesn't capture the data that we've seen since, but we're back up near those, or we did spike to near those same highs of 2007-8, but the Fed jumped in so quickly to try and manage this. They've got it back under control for the time being, but I would contend that they are going to have to continue to lean on the printing press to keep this sort of stuff under control. Corporate debt as a share of global GDP, another interesting chart. You can see there that dark line is the total, and it's basically 95% of GDP. That's going back to the back end of 2019. If you take China out, you get that grey dotted line there. So you can see what an extraordinary binge China has been on in the corporate debt markets here. It's fully 15% of global GDP that they've added on here. And when you get into the bond defaults in China, as we've seen the last couple of years, you can see a material change there. We've had several big issues have defaulted in China, including the one that I talk about in the notes there, China Minsheng Investment Group, which had only been in existence since 2014, and it was backed by Li Keqiang, who was the #2 in China at the time. And generally speaking in China, names that closely tied to senior figures in the CCP tend not to default. So that was a big deal. Here's a look at the total amount of debt across the world. As you can see there, that black block at the bottom of each of those columns is private non-financial debt. And even though the governments have necessarily picked up the slack since 1999, you can see what a decade or more of repressive interest rate policies has done to the corporate debt markets. We've seen a massive spike in private non-financial debt. It's doubled since 2004. Even since 2008, when you think there'd be some kind of attempt at austerity, it's up 25–30%. The third piece that I wanted to highlight came in the middle of the pandemic. This was kind of third week of March. It was called All Things Considered, and what I was trying to do was take a look across the spectrum to kind of gauge where we were right in the middle of this pandemic. So I think this is a useful thing to look at, because with what's happened to asset prices over the last 6 weeks or so, it's easy to forget just how messed up the entire world was back in late March. I began it here with the MSCI World Index. The chart now is wholly different, as I'm sure you all know, but as it says there, 25 trillion or 30% of global equity index market cap disappeared in 21 trading days. It was unprecedented, it remains unprecedented, but I think importantly, it's a lesson that we mustn't forget with markets rallying as they are, that this can happen. I began my career in the mid-80s, and I was fortunate, and I truly mean that I was trading a Japanese equity warrant book during the Black Monday crash in October of '87. And I was completely unprepared for it. I didn't know what I was doing. But having that happen to me so early in my career really taught me what is possible. And I think anyone that's kind of grown up in the last 15 years has a completely skewed idea of what happens when risk gets elevated. So I think it's important to remember what happened to the MSCI World, what happened to the S&P. We saw a couple of kind of attempts to bounce there in the S&P, which we didn't see really in the MSCI world. And looking across the whole of Europe, these charts, we've almost forgotten them now because they just look like another dip on a long-term chart. But I think the severity of what happened is something that we all really need to remember, because I suspect we will at some point retest those lows, and we can talk about that in the Q&A. Small caps, as you see, 40% in 20 trading days, which is an extraordinary thing to witness, but it just proves, again, as I was saying, that these things can happen. This chart, again, showed non-resident investment flows into emerging markets. You can see here just how they've changed. We had that scare in China in August 2015, the global financial crisis there, even the taper tantrum. But COVID blew them all away in terms of the massive amount of money that was pulled out of emerging markets. And a lot of that, I suspect, remains out of emerging markets and has been piled into things like the S&P. A lot of that's continued on the dollar. We'll get to the dollar later as well. But if we see any renewed weakness in the dollar, you can bet some of this money is going to go back into emerging markets and probably take out some of the outperformance of Western markets like the US. Another thing that I highlighted was this, as we had the airlines begging for bailouts in the middle. The biggest US airlines had spent 96% of their free cash flow over the last decade on buying back shares. American Airlines isn't included in the chart because they had negative free cash flow, but the bailout they were asking for was $50 billion, and they bought back about $49.6 billion of shares. And this is one of those things that if the public really understood this stuff, they'd be out in the streets with pitchforks and torches. The global bond market here, we saw $5 trillion wiped off that in just 8 trading days. When things got really, really unsettled. Again, another really big reason why the central banks had to do what they did quite so quickly. And we switched to negative yielding debt, which ideally you would assume, as I said there, by its implication, would be the safest debt in the world, also got absolutely battered when people realized that this disorderly stuff in the equity markets was moving into bond markets as well. And that's, again, a harbinger of what is possible. And it's stuff that we really do need to remember. The Fed balance sheet at that time, as you can see, we'd had this period of since Janet Yellen has said that they were going to slowly unwind QE. And she said, in her words, it was going to be like watching paint dry. And it was until it wasn't. And I think any of us that spend our lives watching this stuff knew that there was going to be a point on that curve where this stuff would matter. I don't think we realized how quickly it would matter. But it's important to understand that that V bottom there that you see wasn't Wuhan. That was the repo market. That was the repo market going into spasm back in late 2019. And the Fed had to jump on that quickly. And I compared it in this piece when I wrote it to the TED spread back in 2007 when that started to get twitchy. And at the time, very few people either watched or cared or even understood what the TED spread was or what it signified. But it was the people that spent their lives watching that pointed out that this was an anomaly and it was one to be taken seriously. And within a few months, when things started unwinding seriously in 2008, everyone realized that the TED spread had told them and had been the harbinger of that. And so everybody suddenly wanted to know what the TED spread was and wanted to watch it. So we do see these things from time to time, and it pays to pay attention. I think the repo market was definitely one of those. We saw that spike in the dollar. Again, everybody looking for safety. That was one of the big contributors to the outflows we saw in emerging markets. It's stabilized since then, and it's come off in the last couple of weeks. But again, over the last couple of days, we're seeing renewed strength. We're seeing all the money that the Fed has printed getting soaked up very, very quickly. There is definitely a big short squeeze on dollars. And you'll see the world currently split into two camps, very, very polarized about whether we're dollar bulls and dollar bears. There's a case for both arguments. Ultimately, I think the bears win out. I think the dollar has to go significantly lower. But before then, the pain trade is most certainly higher. It's a pain trade, not just for the dollar bears, but for just about every market in the world that shorts dollars. And that's a lot of them. So I think the dollar is something everybody needs to pay attention to. And again, we can get into that in the Q&A. The flip side of that, the ADXY, which is the Asian equivalent, you can see has broken resistance there. And that will continue to come under pressure as the dollar strengthens. This is a favorite one of mine, the Aussie dollar. I've written consistently about Australia for the last 4 years or so. It's a country that hasn't had a recession in 30 years. I'm not sure how many of you follow it closely, but it's been evident for the last 3 or 4 years that this is exactly what was going to happen. Australia was going to start to struggle. They were going to have to weaken the currency necessarily, and that was going to feed through into the bond market. COVID gave it a push on, as you can see there, but the trend had been in place since 2018 for weakening of the Australian dollar. And that fed through, as you can see here, into the Australian government bond market. I've been calling for 3 years now that the Australians were going to be forced to do QE. They're there now. The Aussies are doing QE. They're wholly dependent upon China. They have a massive housing bubble. And again, I can get into any of this stuff in the Q&A if people are interested. It's a wonderful country, but it's a disaster waiting to happen from an economic standpoint. This chart I thought was extraordinary to look at. This was the S&P 500 and its performance during recessions. You can see there that the black line is the 2000-2002 recession, which when we compare it to 2007-8 was a mild one. But at the time, it certainly felt pretty bad. You can see how much more severe 2008 was. And then you look at this coronavirus pandemic. Now, obviously, it's bounced from there. But if you look at the economic data, and again, we can talk about that in the Q&A, this fallacy that the equity market is representative of the underlying economy is for me, the biggest disconnect in markets and the one that's going to be most painful when it reasserts itself. This is the Buffett indicator. As you can see here in mid-March, we'd hit the everything bubble level again and then crashed, but we'd only reached levels last seen at the housing bubble, which I would argue was still overvalued. Since then, we've gone back up to those all-time highs. The real Buffett indicator, which we'll come to later on, I think is far more important at this particular point in time. This is a quick chart of investment grade spreads during crises. You can see those slow burns there of 2011 to taper tantrum 2018, when people got worried about the Fed reducing their balance sheet, and again a much steeper rise in 2008. But again, 2020 has blown all of those away, and just shows why the central banks had to get these under control. And as I say there, if you think these things have finished widening, the pressure is definitely to go wider. The Fed is going to have to respond to that, which is going to mean more easing. This is another chart which, again, I think is important. This is the Dow to gold ratio. You can see there the lows, the beginning of the inflationary period in the 80s, the post-Nixon low. That was after the gold window was closed a decade earlier. And then you see a post-depression low. And even though we're coming at this from the lower high, I suspect you're going to see this chart move much closer to those 1930 and 1980 lows as we move through the next sort of year to 18 months. As a result of that, the next piece I wrote at the end of March was around gold, because I had a lot of people asking me about gold. It's something I've spoken about often. I get labeled a gold bug. I'm not. I can hold my hand to the sky and say that, but I think gold has had a place in a portfolio for the last 2 decades. And I think that place has been higher and lower over those years, but now we're at a point where I think everybody needs to be thinking about the allocation they have to gold and precious metals mining stocks. As you can see here, this is the Federal Reserve balance sheet in gold. As gold gets stronger, that ratio comes down, and I think it's going to continue to come down despite the added juice that the Fed is putting into the markets. These charts, when we saw these happen back at the time, I'm sure you'll remember just how shocking they were when you put them in context, going back 50 years. This has kind of gone by the wayside. And this, to me, is one of the major disconnects. There's people like David Rosenberg out there talking about the jobless numbers and how important they are for people to understand. I believe he's absolutely right. I think this jobless, the ripples from the jobless claims haven't really been felt fully yet because of the PPP. I suspect there's going to be plenty more stimulus programs that will need to be applied once this ripples through to the real economy, and once we realize just how few of these jobs are coming back. We are seeing some recovery off the lows, but for us to get back to where we were in terms of the economy, which is what many markets are telling us we will be fairly soon, I think is just whistling past the graveyard. It's going to be reflected here, the US budget balance. You can see there, that's to 2019. The furthest right bar on that chart is going to dwarf all of those as we go into the back end of 2020 into 2021, and necessarily so. They have no choice but to widen the deficit here. This, I suspect, at some point is going to have an effect on the commodity market. Right now, we're seeing this massive demand shock is hitting the commodities. We're back to a level we last saw in the mid-70s. And if you think that the ultimate end game of this is inflation, which I believe to be the case after we get through this deflationary shock, then commodities in and around these levels make an awful lot of sense for people to start looking at owning. This is the ratio of commodities to equities, which is a fascinating chart. This just shows you the financialization of global markets since that inflationary period in the 70s. You know, once we got through there to 80 and inflation started to fall, bond yields started to come down, you've seen the move towards equities versus commodities has been extraordinary. And if we get any kind of inflationary pickup at the back end of this, and we're really starting to see the early embers of that burning, then this ratio is going to reverse. I doubt it goes back to those 70s levels, certainly not in a hurry, but it only has to go back to where it was in 2008 or back to the 1990s. And it's a significant move for everybody who's invested in both asset classes. This is a quick look at Exeter's pyramid. At the bottom of that is gold, and everything as we go up gets more and more risky. You can see fiat currency just above that, but then government bonds, treasury bills, and we go up to derivatives at the top. We're slowly working our way down this pyramid in terms of risk aversion, and ultimately we will end up at gold. People are going to want to own gold. Right now, they're happy owning government bonds, treasury bills, and paper money. But as the finances are laid bare, people are going to want to own those less and what's below them more. And I suspect that's going to happen in the not too distant future. This is the real S&P. This is the S&P 500 divided by gold. As you can see here, the high point on the left there is the dot-com bubble. So when measured in gold ounces, the S&P is still far, far below where it got to in 2000, which just shows you how gold has outperformed equities over that time. We see these big downdrafts when we get bursts of bubbles. We saw the start of another one here. I think no matter what the Fed does, you are going to see gold outperform over the next couple of years as people move down that pyramid I showed you in the previous chart. This is a quick look at Homestake Mining, which was the big gold mining stock. And it's important to notice that the Homestake Mining scale on the left-hand side of the axis is a logarithmic scale. And this is what it did during the roaring 20s. You can see there, the gold shares flew higher. As you can see at the height of the market there, when the market first fell, you saw Homestake Mining went down with the rest of the market. But then as the bear of the Great Depression resumed, Homestake Mining took off. Precious metals were the only thing to own. And it outperformed the Dow Jones significantly. The two lines there are Executive Order 6102, when Roosevelt confiscated private ownership of gold. And then again, the dollar devalued. People worry about private ownership of gold when these events happen, but owning the mining companies is a great hedge against these kind of extreme outcomes. This is another chart, the gold-silver ratio that I was pointing out at the time, again, 2 months ago, that this was an important chart to realize that was going to reverse, and it's reversed already. It's significantly lower than this. Already, as people start to price in inflation, silver is really the best barometer of inflation you're going to find in the precious metal space, and it's already sniffing out some serious inflation coming down the pike a bit later on. This chart I thought was interesting. It shows you just how quickly you can get these inflationary surprises. In 1915, we had inflation of 1%. 2 years later, it had risen to 20%. Obviously, that was World War I. We saw the same thing in World War II. At the end of World War II, 1%, we came off rationing, and it just shows you how quickly inflation can get out of control. And then we saw this in the 70s, obviously the big inflationary spike with the twin oil crisis at the beginning of the 70s. And the purpose of this chart is really just to show you how benign these things can be before they explode. You don't tend to go from 1 to 2 to 3. You go from 1 to 3 to 10. And people tend to think that won't happen, and it can't happen in Western democracies because it hasn't happened really since the Weimar inflation, taking that 1970s period out of it, but it can happen, and it very probably will at some point. And then this chart, just real assets versus financial assets. Again, it speaks to the financialization of the economy, and the lower that chart is, the lower real assets are versus financial assets. And again, I'm a great believer in reversions to the mean, and that to me just screams that we've reached the end of the road of financialization, and people are going to want to own real assets to protect them from the kind of blowback from that era of financialization. One of my most recent pieces was this one. We've got a couple of minutes left for this, and we'll get some questions. The Johnny Nash equilibrium. And I was talking about the Nash equilibrium and game theory. For me, the Johnny Nash equilibrium was simply there are more questions than answers. And the point I was trying to make at the time was that we were in this flux period where we'd seen a lot of those charts that I've gone through already. You saw what had happened to markets. And all it had really left us with were questions. We thought we had the answer to them early on, but stock market performance has kind of confounded a lot of us who really figured that the economic data was going to matter a lot more than it has. Some of the questions that this asked that I was pondering, I went back to the Great Depression, which really is the best parallel we have, the best analog for what's happening now. We saw that rally, as you can see there, 44%, which is similar to the rally we've seen here since the lows back in February, March time. But it took the Dow 25 years to recapture its previous high. Now we've seen a significant rally, and it looks like we are going to regain our highs potentially. The Nasdaq certainly done that already. But you see what happened after that reflexive rally. The market fell 85% shortly thereafter, and that's my fear. That's my fear. That's what I worry about happening here. That this rally, once the economic data starts being reflected in first earnings and then forecasts and finally equity prices, this is what we're going to see, and it's something that I think people need to take very, very seriously as a potential outcome. The unemployment rate here, as you can see, the Great Recession, really nothing compared to the Great Depression. And where we are today, we saw that obviously that big miscalculation that was announced last Friday. It's difficult to see how bad the current employment is going to be when compared to the Great Depression. And a lot of that is to do with the employment to population ratio, which that chart's in here. We're not quite there yet. Here's the unemployment rate now, 15%. Again, they were talking that it may have been 19% based on those miscalculations, which is, I guess, at the same time, extraordinary and perfectly understandable. They could be that far out on unemployment. So the data is not to be trusted. And I think we have to err on the downside of these numbers. Now, this to me is the real Buffett indicator. This is the cash and cash equivalents held by Berkshire Hathaway. You can see what they did during the Great Recession. They put cash to work as hard and as fast as they could. You know, Buffett cut himself some sweetheart deals with the likes of Kraft and Goldman Sachs, of course. But they've really been raising cash ever since they got those deals. All the way through this, the cash has been getting stronger and stronger. And through this, I don't know how many of you watched the ASM, which is when you share it of the adoring fans of Warren Buffett. It's a very strange experience to watch. And whether it was that or just Buffett's tone, but it was very different. His tone was very different. You know, he was talking about letting some of the companies that they own shares in go bankrupt and restructuring them rather than putting more money in. And he wrote an op-ed for the Journal back in 2008, is basically saying why I'm buying America. Nothing of that sort this time. And I think a lot of people throw stones at Buffett, but his track record over the years has proved him to be a very astute investor. And I think the fact that he's raised quite so much cash as he has at this particular point in time is something people really need to be paying attention to. This chart I just find fascinating. As I said there, in a world filled with alligator jaws, this is perhaps one of the most dangerous to potentially close. This is US debt to GDP versus monetary velocity. You can see there the monetary velocity. I think I'll finish up with that chart on its own. We'll get to that shortly. This is the S&P 500, the dark line there, versus earnings estimates. And you can see on the very right-hand side there just how detached from each other these two have been. The earnings, 12-month earnings, have been falling like a stone, and they continue to do that with companies pulling guidance left and right, while the market continues to make new highs. Obviously, you can see this chart is more recent in vintage, but the S&P is even higher than this now. This is that chart I was talking about, the employment to population ratio, and this I don't think people are factoring in enough. You can see there just how enormous this decline has been. And that is something that I think way too few people are paying attention to. You know, that chart goes back to 1948. You can see we are in completely uncharted territory here, and the number of dependents we're going to find on the state when this comes back, even when the jobless numbers get worked through the system and get corrected, this chart guarantees that the numbers are going to be way worse than the headline and way worse than people potentially factor into their stock market predictions. Nasdaq forward PE, you can see here, this is, as you can see, after the pandemic. We've bounced back to places we haven't been before. This is back to .com levels. Again, extraordinarily misplaced in my opinion, particularly when you look at that NASDAQ and how much of that is really based on a very small handful of stocks. The leadership is getting narrower by the day. And here's the consumer. 70% of the economy, revolving credit card debt fell $28 billion. Again, this chart goes back to the 60s. And without that credit, they're pushing on a string. If consumers don't want to take on credit, which I think many of them are going to be reluctant to do, there'll be those that are forced to do it, but many are going to be reluctant, then this is a major problem that the Federal Reserve is going to have to step in and try and do something to counteract. And here you can see again, total consumer credit in 1 month. We took out, that's 2007. Obviously that big dip there. We're back at a point where we had a $12 billion decrease from the prior month in March, when they were expecting a $15 billion increase. So again, we are in uncharted territory. And it's not just the US, this is the UK. These are UK annual declines in GDP greater than 4.5%. As you can see, we go back to the 1700s in the UK to find anything as remotely severe as this. And the jobless numbers in the UK are very similar to those in the US. Here's estimates for the US budget balance. You can see how quickly people found religion about what was going to happen. And again, we saw that chart earlier of the budget balance. It's necessarily going to have to be blown out to places we haven't seen in our lifetimes. And here's that velocity chart. Unless they can turn this around, they're going to have a real problem. They've been trying to do it for the best part of 20 years now. They are pouring the kindling onto this fire. And at some point, this chart will turn around. And the worry at that point becomes, can they withdraw the stimulus quick enough to avoid significant inflation? Only time will tell. But again, this is a very important chart for people to be looking at. Now, this is yesterday, and this is what I wanted to get into in the Q&A. I've slightly run over the time I'd planned, but you look at these charts here. As of June the 8th, yesterday, not a single stock had fallen in price in the S&P 500 over the last 10 weeks. When you think about what's happened to the economy in that time, that's a truly extraordinary state of affairs. That chart on the right there, you can see what I call there the orgy of retail speculation potentially reaching its climax. We're seeing bankrupt companies go up, hundreds of percent. We're seeing casino gambling. We're seeing day traders. We're seeing people who used to bet on sports being talked into jumping into the stock market by guys that run Barstool Sports. What's happening is extraordinary, and I've seen this before. It will end in tears. Does it end today, tomorrow? I don't know. Can we go higher in the short term? Absolutely we can. But the people who are driving this market now, and we should get into it in the Q&A, are the people who always end up having their shirts handed to them by the professionals at the end of the day. And I think this time will be no different. So that was a very quick whiz through. So I've run over. I've left 25 minutes for questions, hopefully. So Vince, I'm happy to take any. I hope I didn't go through them too quickly, but feel free to go back, forwards, wherever you want to go.
Sure. Thanks, Grant. That was great, and a lot of information there. I definitely encourage anybody to check out all of his other work. He's got a lot of terrific interviews with a lot of big name investors that paint a really good picture of the economy, and learn tons to learn. If anybody wants to answer questions, if you sort of hover your mouse over the screen at the bottom, there's Q&A. Click on that box and ask any questions that you may have. First question for you, Grant, here from one of the listeners. It says on all fronts, we see global debt increasing considerably over time, right? So I think our fiat money system's built off of debt. Is this good, bad, neither, necessary? Like, is the system designed just to have ever increasing debt? And that's sort of this MMT theory, right, that people are talking about. So if you want to comment around that.
Yeah, look, it's absolutely necessary. It's necessary to maintain the system now, which is why basically all the measures that have been done have been done. We've seen student loans going through the roof. We've seen auto loans going through the roof. We've seen revolving credit. We've seen everybody who can take credit being offered credit. And a dear friend of mine who does one of these podcasts with me, Stephanie Pomboy, who is one of the smartest analysts you'll find anywhere in the markets, has been talking about this for a long, long time. She said that, that there comes a point when people don't want to take credit on, and there's nothing the Fed can do to force them to take it. They've made it cheap. They've made it attractive. But after 2008, the savings rate went up. after what we've seen just now, the savings rate has spiked again. And if people start saving, that's a major problem for a debt-based financial system. They have started saving. Obviously, the massive surge in unemployment is going to be a significant tailwind to those savings. And even the people that have jobs through this, there was a chart put up by Torsten Slok, the great economist at Deutsche Bank yesterday, that showed that 50% of US households had lost employment income over the last 2 months. So, if 1 in 2 households has suffered from unemployment, whether it's mum, dad, or the kids or something, everybody else that has a job gets a lot more leery about spending their money. I know my spending patterns have changed in lockdown. I mean, literally for 2 months, 3 months, I've spent money on food. That's it. And the people that I've bumped into and chatted with at the grocery store, I've talked to seniors at the grocery store. And one guy said to me in a queue, he said, my wife and I were spending $4,000 a month. We spent $1,200 a month over the last 3 months, and we're not going back to that $4,000 a month. We've realized a whole lot of things about how we can live. So yes, it's a long answer to your question. I want to get to as many as we can. So the debt is absolutely necessary to maintain the system. The question is, who is going to take on that debt? At the moment, it seems to be we've run out of households. The corporate debt bubble is in the process of bursting. So that's all going to fall back on the central bank balance sheets.
Okay. Another question is, can you elaborate on the disconnect between equity markets and the economy? Clearly, there's been a disconnect for years. It's grown even greater recently. So yeah, I mean, when do you think truly the link broke down? Why did it break down, and will it reconnect? What might trigger the reconnect? You would think that this might trigger the reconnect, but it clearly hasn't because of every central bank injecting more stimulus. So, any thoughts?
I think for me, I go back to the Greenspan put in '87. That to me was the beginning of this. It seems a long time ago, and because I had a ringside seat for that, it's to this day it's still very fresh in my mind. And Greenspan at that point came out really for the first time and essentially said, I've got this, we'll backstop the markets. And it's taken time for that message to get through to investors, to really have that confidence that the Fed has their backs. We saw that confidence get more and more pronounced. We saw it after 2000, we had the dot-com bust. And Greenspan, the Fed came in, went through the same playbook and things bounced back. That the recession was shorter. The market bounced, particularly the NASDAQ, took longer to get back. But given what had happened, the market was certainly confident in the Fed. And then after 2008, when they really kind of let the dogs out, I think that was what cemented in people's minds this what's become known as the BTFD mentality, it's buy the dip mentality. And look, it's been a winning strategy. It has been a winning strategy, and the people who've done that have done okay. I mean, I argue with people all the time. So if you'd bought gold in the 90s, you can buy exactly as many shares of the S&P today with your ounce of gold as you could back then, and you've had none of the stress that you've had being long equities and having to sit through all that stuff. So for the market timers, it's been great. So I think that's where the disconnect started. I think there will be a reconnect because what we're dealing with here are really natural forces. If you think about what markets are, they are nothing more than the representations of the collective greed and fear of market participants. That's it. We're all humans. We all suffer from fear, and only some of us suffer from greed. And I think that's why the falls are always so much more dramatic, because everybody gets afraid and only some people get greedy. So can the Fed subvert forces of nature? No, I don't think they can. Can they hold them at bay for a while? Yeah, they can. But Canute held the tide out for a while, but eventually it just swamped over his chair. And that ultimately is what I believe we'll see happen. Now, the $64,000 question is always when. No matter what we're talking about, it's always when. And it looked for a time at the beginning of this as though the market was going to reflect the economic reality. And I think what we saw, both in the equity market in those very early days before the Fed jumped on this, and more importantly in the bond market, and I was talking to a friend of mine, Luke Gromman, about this last night, when we saw the Treasury market really become dysfunctional for a couple of days early on in this, before the Fed stepped in, I think what we got there was a window to what the world looks like either without the central banks involved or when the central bank policies lose their efficacy. And it was a very scary world. We had, markets falling 12, 15% in a day. We had the treasury market essentially not functioning, no bids, no offers, wide spreads. And people need to pay attention to that, because when the Fed comes in and puts a Band-Aid on this and kind of gets the horses back in the paddock, that's fine, but it's a very dangerous thing to assume that the horses aren't going to want to break out the paddock again. And that's where we're at now. The economy, the data all tell you just how appalling this is, just how big a problem commercial real estate has, for example, with rents not being paid, how big a problem the unemployment situation is going to be, how slowly economies are going to get back to where they were. And the market simply isn't reflecting that. I can't tell you when it's going to happen. I can tell you it happened for a brief period, and the Fed jumped in, as did the other central banks, to stop it happening. And so for me, the question is, okay, I know that that's what needs to happen. I know that's what the market forces are trying to make happen. And I know that central banks are going to do everything in their power to stop that happening. And we've already had people like Lagarde use the term unlimited. We've had Jay Powell talk about the Fed having an unlimited balance sheet. And at this point they do. They will print whatever it takes, to coin the Draghi phrase. They will print whatever it takes to keep the wheels on this. But ultimately, there is going to come a point in time where you can print money, you can't print jobs, you can't make people spend it, and you're going to end up pushing on a string. So I think we're dangerously close to that point in time. I think the confidence that people have in the Fed is at its most dangerously misplaced at this particular point in time right now.
Okay. Another question here. You state that the investors pushing share prices up despite lower earning expectations are the same investors who always have their shirts handed to them. We've seen it before in '99, the IPOs, buying properties in '06, sort of house flippers. Is there data to support the idea that it is the same type of investor pushing stock prices higher again today?
Yeah, there's data, although I would actually say it's a slightly different version of the same investor. I mean, what's happening is truly extraordinary, and the clue was in that page. I'm going to go back on that page here. You can see here over on the right there, you've got number 2 there, Chesapeake, up 153% yesterday. This is a company with $22 billion in debt. It's got a $2.2 billion bond of 2025 that's trading at 5 cents on the dollar. And the equity is up 153% to a market cap of $650 million, $22 billion of debt. Hertz, you see there, Hertz is up a couple of 100% since it filed for bankruptcy. It's up 257% since filing for bankruptcy. And there's a bunch of these. Nikola, you see down there at number 11. This thing has a $37 billion market cap. It's a pre-revenue truck maker. That's twice the size of Ford. And the common factor to all of these is Robinhood. Robinhood, the app which allows you to trade without commissions, which has kind of been embraced by, and I really don't mean to use the term millennials pejoratively. They advertise themselves as the millennial trading app. But what you've had is this extraordinary confluence of events where you have people who want to play the stock market being given an app and appealed to in social media and enticed to come and do this with no fees. It's been gamified, which appeals to those people. And then you've had the pandemic. And you throw into the mix people who are sitting home with a $1,000 check from the government that can't go to work. The stock market has become a game. You have no sports going on. So you bring all the sports bettors into the stock market. And the evidence is all there for this. There are 800,000 new accounts opened across Charles Schwab and TD Ameritrade a few weeks ago. And if you look at Robinhood, there's a site called robintrack.net or .org, one of the two, but it's RobinTrack, you'll find it. And it shows you the most popular stocks being owned. And there are something like 100,000 plus new owners of Hertz in Robinhood since it went bankrupt. There are a similar number of new holders of Chesapeake Energy. at a $650 market cap when the thing is going to go potentially today. They're going to file. It was halted when we started the webinar. The stock was down 40% in aftermarket trading last night when they said they might file Chapter 11. And so all these guys who are literally punting the stock market. If you haven't seen Davey Day Trader Global, Dave Portnoy on Twitter, then look at him. I mean, kudos to the guy for what he's done, but you know, I struggle to look at it. It makes me sick to my stomach to watch, to be honest. Mainly because look, he's got a couple of $100 million that he's made from Barstool Sports, and well done him. But the people that are going to lose their $1,000 paycheck and their $2,000 savings because of following him, it's such a shame, and it's so sad to see, and it will happen at this point. But yeah, so the data is there, and I would urge you to look at Robin Track, go through it. The data is fantastic. Look at which stocks have been bought. Basically, what people have been doing is buying the ones that have fallen the most. The fact that they're going into bankruptcy, you see on the bulletin boards on Reddit, people explaining that bankruptcy is a good thing if you're an equity holder because they're going to restructure their liabilities. And people say, oh, well, that's great news. This is going to be great for the equity. So you have people that genuinely don't understand how the capital stack work, how Chapter 11 works, how stock markets work, who are playing a game on an app with real money. And I talked to Kyle Bass a couple of years ago, and he explained to me that the worst thing that ever happened to him in his entire career was that the first short trade he put on went to zero. And it cost him a fortune over the next few months because he figured, well, this is the easiest thing in the world, short trade. And everything he tried blew up and he didn't know how to handle it. And we're seeing that here. We're seeing inexperienced investors get in, make crazy gains that there is no rational reason for them to make other than the rest of their ilk bidding the stock up among themselves. And so that's going to end in tears. I suspect very soon, I have a feeling that this is an orgy of a climax of some sort that we're seeing in these speculative stocks. But yes, for all the anecdotal data you want for this, go to Robinhood and go to robintrack.net or .org. You'll find it.
Yeah, I've actually looked at that in around March, April, the amount of users in those names went parabolic.
Yeah,
so,
exactly right. And it's every name that you shouldn't own because they've fallen when the experienced investors sell them. These guys are buying because they've fallen. It's great while it lasts, but it's going to be a shame when it ends.
With that, I think a question that is interesting is, when the central banks, every time there's been a fire, 2018, even the end of 2018 Q4, the market was down 20%, and all of a sudden they reverse all their policies and, start easing again. Fourth quarter, you had sort of 19 WeWork blow up. And sort of that's when the repo market really started coming under pressure. And then here again, just pumping tons of money in. And it really does seem like they're there to support the markets, and they've eliminated risk. And now they're buying corporate bonds and high yield bonds. And so it really does force investors, when I think of as an investor, where do I put my money? Where do I earn yield? Where do I earn a safe yield? And if you can't earn it in treasuries, does that distort modern portfolio theory where you'd have the safety of government treasuries? Like you said in March, where they were losing control and the interest rates were actually going reverse. So stocks and bonds were going down. That portfolio construct didn't work, and it's forcing investors outside that curve now to go into corporates and high yield as the Fed suppresses those rates. And so people are going further and further on the risk curve to make money. But how do people make money going forward? And if the Fed's there to sort of print it and there doesn't seem to be ramifications, when does the ultimate ramification happen, or what could be those types of triggers that changes, or should you think differently about your portfolio construct?
I absolutely think everybody needs to think differently about their portfolio construct because we are in uncharted waters here, right? What's happening now really hasn't happened. The closest we've seen to it was the Great Depression. But there are so many moving parts of this crisis that are wholly different to that. It's just the best analog we have. If you go back to early 2007, you could buy a 2-year treasury and earn 5%, right? So I gave a presentation at that time in Seattle to some high net worth individuals, and sorry, it wasn't that time, it was 2012, and I contrasted that with the same investment in 2012. And I said, like, if you had $10 million in treasuries, 2-year treasuries, you're earning $500,000 a year. You're a rich man. You've got your capital. You can live a really nice life with $500,000, a really nice life a year, and never touch your capital. And today, at the time, your return on that same treasury position was $13,000. And a guy came up to me after and said, yes, he said, I haven't been able to understand. I'd built a business up and I swore that when it was worth 10 million, I was going to cash out. And my wife and I were going to retire and live a nice life. He said, and I sold the business for $10 million. And we can't afford to go on a holiday this year. And that brings it home to me. So how can people earn a return on investment? Simple, take risk. And that's exactly what the Federal Reserve policy is designed to do. It used to be that you didn't have to take risk, and nor should you have to take risk. You know, the whole idea of savings and capital preservation is that you don't have to take risk if you don't want to. But making risk compulsory, for me, is the most heinous part of this policy over the last 20 odd years. I mean, it's been creeping that way for more than that. So when you talk about, do people have to rethink the portfolio? Absolutely, because what is the risk-free asset now? Is the risk-free asset a negative yielding bund? It's hard to make a case for that because you're guaranteed to lose money on it. I would argue that's a big reason why gold needs to be rethought and needs to have a place in every portfolio. And I believe now, having been creeping higher, that position in gold, certainly for the short term, while this uncertainty is going on, needs to be significantly higher than it has been. The answer to me is to try and get away from this belief that has been inculcated in all of us, really, that the stock market's the only game in town. For investors, the thing to do is to find a business to invest in, a private business that isn't listed, that doesn't move up and down with the stock market, but find a local business. And there will be plenty of them that need money right now, that need capital investment, and you will be able to get a decent return on your investment. And lending money privately to a local dry cleaner who needs money to get him back on his feet after the pandemic. And this is a business you've been using for 25 years, and you know that everyone else like you is going to go back to that dry cleaner. Those are the kind of places that people need to be looking. Communities, neighborhoods, private investments, instead of focusing on listed equity markets and fixed income markets, which have had every ounce of juice squeezed out of those lemons over the years. And now we're at the point where the Fed is stamping on the rinds, trying to squeeze the last bit out. And I suspect they're close to doing that. And once that happens, you're just left with husks and there's nothing in there. So I think people need to be really, really careful about being caught in that mindset of equities and bonds and listed instruments in the stock market, because right now, I don't think that's the right place to be.
I think, another question here is around some of the technology companies and the monopolies and their access to cheap capital that's provided by the Fed suppressing rates, right? And if you look at the largest corporations and investors clamoring to give out, 30-year loans to these corporations at 2%.
Yeah.
So capital for them is free, basically, to do whatever they want with, which helps bolster their profit margins and further entrench their monopolies. Is there anything to be said why capital is flowing to those because of perceived monopolies into perpetuity? I mean, it's hard to fathom true competitors, especially when we just put out a business, a lot of small businesses, right?
Yeah, I think
large corporations.
Yeah, but it goes back to your previous point, right? It's the perceived safety. It's as close to a risk-free asset. You could probably argue that if you take a monopolistic breakup out of the equation, Amazon is a better credit than the US government, right? You can probably argue that now. Certainly Google, maybe even Facebook, these big tech companies, and that's why people are doing this, because they're perceived as safe. And you do have that feedback loop that you just talked about, where you just reinforce the strength of their position. So look, it makes perfect sense to me. Whether it works out, I suspect, and if you look around the fringes, you'll see the amount of ink being spilled towards breaking up these tech companies is getting louder. What the stuff we've seen President Trump do with Twitter spats in the last couple of weeks or so tells you that going into this election, those big data companies are going to be a very, very hot battleground for the two competing sides. And the incumbent with all the power is not going to be wanting them to be more entrenched and be more powerful. That's for certain.
I'll end the last question with, looking at U.S. monetary and stimulus and fiscal stimulus compared to other developed world, right? And also you can look at the strength of the dollar or weakness versus other currencies, and then the case for gold of what really changes. The U.S. obviously is extraordinary monetary policy, going to run extraordinary deficit, but so is, we'll call it, the rest of the world. And with the U.S. dollar being the world reserve currency, it sort of allows it that luxury. What if anything breaks that dynamic or that trust with the rest of the world that entrusts us with that honor to have the world reserve currency?
Well, it's a really good question, and I think that if there's one question that everybody is really trying to figure out the answer to, it's that one. Because ultimately, if you go back through history, you'll see that, with the exception of today's cohort, every fiat currency in history has failed and gone to zero. And the dollar's purchasing power since 1971 has fallen 96%, I think it is. So again, this is another one of those questions. We know what the end game is. The dollar becomes worthless, just like the euro does, just like the British pound does, just like the Japanese yen does. They all do. And you can see the path we're taking here, that the central banks are going to have to monetize all the debts. And if we do get this debt jubilee, which everybody's talking about, really the only way to kind of work your way through that and out the other side in terms of where does the pain get felt, it's going to be in the currency. And again, I don't want to sound like a gold bug, but this does bring me back to gold, because at this point, the central banks are so deep into this that they cannot turn around. And that chart that we saw with the watching paint dry, when the repo market cracked, that shows you they can't turn around. And so what they're going to have to do is continue to print money to solve these problems. They may pay lip service to unwinding the balance sheet, and they may reach points in time where they have a window to try and do that. But as we saw at the end of last year, when that changes, they will buy print money in ever steepening amounts. So we're on that road. You look at the Bank of Japan, it now owns 80% of the ETF market in that country. And they're closing in on, I think, 40 or 50% of the JGB market. And this is where Bill Fleckenstein's cold fusion theory comes into place. Do we get to the point where they own all the bond market, and then the Bank of Japan and the Treasury exchange a note for the entire amount for 1 basis point perpetual and just wipe the whole thing off? Well, if they do that, the only way that gets represented by investors is in the currency. And ultimately, the Fed's on the same path, the Bank of England's on the same path, the PBOC is on the same path. They're all on the same path. The euro the ECB, sorry, has a slightly more problematic path because of the different competing countries and the lack of a fiscal union. And we've got this this vote by the German Constitutional Court happening right now that has thrown that into doubt. The ECB and the European Court of Justice have basically ridden roughshod over the European Constitutional Court, not because they want to, but because they have to keep the wheels on this thing. So it's going to happen. What makes the dollar finally crack is anybody's guess. And the argument that it is the cleanest dirty shirt or the prettiest horse in the glue factory, whatever you want to call it, is absolutely true. But I think it doesn't necessarily have to be that the dominoes topple one by one and then the dollar goes, which a lot of people will contend. I think you might find that we get serious currency crises, plural, in 2 or 3 major currencies, and that takes the dollar down with them. And when that happens, when currencies go, everybody is going to necessarily move to gold. And look, Bitcoin has to have a place in this argument. I haven't seen enough of how it performs in a crisis yet. I think everybody should own some Bitcoin as a tail outcome option, but I haven't seen how it performs in a crisis. So I know how gold performs. So I'll have a decent amount of gold and a little bit of Bitcoin. If you held a gun to my head and say pick one or the other, I'd pick gold just because I've got a frame of reference. But a lot of people say Bitcoin. I can see the answer to both. But look, I can't tell you when is the simple answer. The dollar will crack. I don't know when. It could crack up first before it melts down. But ultimately, all these roads, and Kirill Sokolov said this 3 or 4 weeks ago, all roads lead to gold. And I think he happens to be right.
Well, thank you for that. That little bit about Bitcoin, we have Mark Yusko coming out in September to hopefully educate us on cryptocurrency here
Great.
for the CFA Society of Detroit.
Fantastic.
So that'll be interesting to learn more about that. Really appreciate your time, taking the time to do this. I sort of was in charge of programming here with Ashley, and we're like, hey, who can we get to come speak? And sort of threw it out there with the hopes that you'd actually answer email, and you did. And very thankful for taking the time to educate our members and do this for us. So.
Well, you're very welcome. I would love to have come and seen you in person. Detroit holds a very special place in my heart because it was the first US soil I ever set foot on as an 11-year-old boy. So it has a very special, I looked up at all those buildings. I'd never seen anything like it. And I fell in love with America on Detroit soil. So it has a special place in my heart.
All right. Excellent. Well, thanks again, and hope to hear from you again in the future.
You're welcome. Take care.
Thanks, Grant.
And for our members, whoever's still on, don't forget about our annual meeting next Wednesday, or the 17th at 2 p.m. Look forward to hearing from you then. Thanks. Bye.